You're making $80,000 a year. On paper, that sounds solid, responsible, middle class. You've saved some money, you're tired of renting, and one night around midnight, you open Zillow just to see what's out there. Every house that doesn't look like it's actively collapsing costs at least $400,000. The kitchen hasn't been updated in 20 years. The carpet is that tired beige that signals surrender. The basement has wood paneling from another decade, and somehow it's labeled a starter home. The bank says you're approved. The agent smiles and says this is normal. Your parents ask when you're finally going to buy. So what's the problem? The problem is that you can't actually afford most of these houses, not in a way that allows you to sleep at night without checking your bank account every 3 days. Today, we're going to calculate what your salary truly buys you, not what the bank says you qualify for, but what you can afford without turning your life into a decade-long financial stress test. The income versus the price reality. The median household income in the U.S. is roughly $83,000. That sounds like it should support a decent home in a decent neighborhood. But the median home price sits around $415,000. That means the typical home costs about 5 times the typical household's income. Historically, homes were closer to 3 times the income. That difference changes everything. At 3 times income, you're stretched but stable. At 5 times income, you're exposed. Yet the messaging around you says this is normal. The math quietly says otherwise. What the bank approves isn't comfort. There's a common personal finance guideline known as the 28% rule. It suggests you shouldn't spend more than 28% of your gross monthly income on total housing costs. That includes mortgage, property taxes, insurance, and HOA fees. Banks, however, often approve buyers up to a 43% total debt-to-income ratio. That includes housing, plus car payments, student loans, credit cards, and everything else. Here's what matters. The bank's job is not to ensure you live comfortably. The bank's job is to make sure you don't default immediately. Approval does not equal affordability. It simply means you fall within the maximum risk tolerance they're willing to accept. What a $400,000 house really costs. Let's walk through the numbers. You buy a $400,000 home and manage to save 10% down, which is $40,000. That likely took years. Your loan becomes $360,000 at around 6% interest. Principal and interest alone land around $2,150 per month. Now add property taxes. Conservatively, that might be $450 per month. Homeowner's insurance could run $300 per month. Because you didn't put 20% down, you're paying PMI, perhaps another $275 monthly. Then there's maintenance. The general rule is 1% of the home's value per year. On a $400,000 house, that's about $333 per month. Add it all together, and your real housing cost approaches $3,500 per month, not $2,150, not the number the mortgage calculator shows up front, the real number. The income you actually need. If we apply the 28% rule to that $3,500 monthly cost, you'd need to earn about $150,000 per year to afford that home comfortably. The bank might approve you closer to $98,000. That's more than a $50,000 gap between approved and financially stable. Only a minority of households earn $150,000 or more, which means most people shopping in the $400,000 range are stretching beyond comfort. The $80,000 household example. Now, imagine a household earning $80,000 combined. After taxes, that might translate to roughly $4,600 per month take-home. If housing costs $3,500, you're left with about $1,100 for everything else. Car payments, insurance, fuel, groceries, utilities, student loans, healthcare premiums. That money disappears instantly. There's no room for savings, no buffer for repairs, no margin for mistakes. That's what being house poor looks like. You technically own the home, but every unexpected expense feels like an emergency. The water heater fails, the roof leaks, the HVAC breaks in July, and suddenly you're financing repairs while convincing yourself you're building equity. Contrast that with a household earning $200,000 per year buying a $500,000 home with 20% down. Their housing cost might sit around $3,700 per month, but that represents closer to 22% of gross income. They can still invest, still save, still handle repairs without panic. Comfort in homeownership isn't about approval, it's about breathing room. Location changes the equation. A $500,000 budget in a high-cost city might buy a modest condo with steep HOA fees. In parts of the Midwest or Southeast, the same budget buys space, land, and flexibility. The housing market isn't uniformly broken, it's uneven. In some cities, median income and median home prices are misaligned to an extreme degree. Geographic flexibility can change your entire financial trajectory. The generational shift. Many parents point out that they bought homes at a similar age, but the ratio between income and home prices has shifted significantly over the decades. In prior generations, homes were closer to 3 times the income. Today, it's often 5 times or more. Yes, interest rates were higher in some past decades, but purchase prices were lower relative to wages. Down payments were achievable in fewer years. Student loan burdens were lighter, car payments were smaller. You can refinance an interest rate, you cannot refinance an inflated purchase price. The hidden ownership costs. The mortgage payment is the starting line. Roof replacements can cost tens of thousands of dollars. HVAC systems fail, appliances break, plumbing leaks, property taxes increase, insurance premiums increase. These are not rare events, they are predictable over time. If your budget is already tight, maintenance becomes debt. Debt shrinks your buying power. Car loans and student loans quietly reduce how much house you can afford. Every few $100s in monthly debt lowers your qualification significantly. Many buyers don't realize how much their existing obligations limit their margin for ownership until they run the numbers honestly. The down payment problem. Saving 20% on a $415,000 home requires over $80,000. For many households, that takes years of disciplined saving. Meanwhile, home prices may continue rising. The target moves while you chase it. This delay frustrates buyers, but rushing into ownership without sufficient reserves often creates greater long-term stress. Renting versus buying. In many major cities, renting currently costs less than owning when you factor in full expenses. Buying only becomes financially advantageous if you stay long enough to offset transaction costs and price growth. If you're renting and building savings, you're not necessarily falling behind. You may be preserving flexibility. Before you sign anything, pause. Ignore the approval letter. Ignore the pressure. Ignore the idea that renting means you're behind. Run the real numbers. Look at your take-home pay, not your gross salary. Factor in maintenance, taxes, insurance, and the fact that things will break. Ask yourself one honest question. Does this house give me stability, or does it give me stress? Homeownership isn't a trophy. It's a financial commitment that can either build your future or quietly limit it. Your salary buys what the math supports, not what the listing price suggests. The smartest move isn't buying as soon as possible. It's buying when it actually makes sense. Like, subscribe, and turn on the bell icon.